When used in isolation, most candlestick patterns lead to inconsistent results and unexpected losses for everyday traders. These failures usually stem from a single mistake. Traders look for patterns on low, noisy timeframes without any broader market context to support the move. By the end of this tutorial, we will build a complete high-probability trade setup directly on your screen, step by step. To follow along, open your charting software and select any trading asset you prefer. Once you implement this setup, your trading transitions from a series of guesses into a structured, repeatable system. Step 1 is upgrading your data feed. Change your chart settings from a standard line chart to a candlestick chart and lock your time frame to the 1 hour or daily view. A standard line chart is limited. It only plots the final closing price for a given period, which hides the volatility and price action that occurred before that close. This side-by-side comparison shows the exact same historical price movement. On the line chart, on the right is the candlestick chart, which provides a higher density of data for the same period. An isolated candle gives 4 vital pieces of information: the open, the high, the low, and the close. The solid body shows momentum, while the thin wicks show where price was pushed and then met with directional rejection. Candlesticks act as a detailed historical record of the battle between buyers and sellers within a specific window of time. With our chart set, we apply a core rule of this system: never trade patterns in random locations. We only look for signals at predefined key levels. Identify where the price recently bounced and draw a horizontal line across these points to act as support. Next, draw a diagonal trend line connecting the lower highs. The specific zone where these two lines intersect is called a confluence level. Waiting for the price to reach this exact confluence level eliminates market noise. It ensures you only act at the specific price points where multiple technical signals align. Now we watch the current price as it approaches our newly drawn confluence level. We expect a reaction here, but we need proof. We wait for a specific confirmation trigger called the shrinking candles pattern. At our key level, 3 green candles approach the confluence line, each visibly shorter than the last. This indicates buying momentum is slowing at resistance. The trigger completes when a large red candle forms immediately after, closing entirely below them. This sequence proves buyer exhaustion at the exact moment sellers take control, validating our trade thesis. With the thesis validated, we set our exact trade parameters. Place your entry point at the closing price of that large red trigger candle. Place your stop loss just above the highest wick of the shrinking candles. If price crosses that extreme wick, our reversal thesis is invalid. Finally, calculate the take profit by measuring the distance between entry and stop loss, multiplying it by 2, and placing your target there. A 2-to-1 risk-reward ratio provides a mathematical edge for your portfolio. By targeting twice what you risk, the larger wins can offset the losing trades that are an inevitable part of any system. Our screen now displays a professional-grade setup, a confluence key level, a strict confirmation pattern, and clear risk-reward framing. This is the setup in motion. The price reverses off the confluence level, tracks downward from our entry, and strikes the take-profit target. The shrinking candles pattern is highly effective, but it is just one of several triggers, alongside others like the engulfing pattern, the pin bar, and the 3-bar reversal. To see real trade examples of all 6 proven patterns, equipped with these patterns and a rigid structural framework, you no longer have to trade on emotion. You can execute with calculated precision.